All right. Thank you very much for the kind introduction and for inviting me to talk about something that I've been thinking about for the last decade. So, hence a decade after the crisis. Happy 20th anniversary to FSI. I'm assuming there's going to be a cake at the end of this with so many birthday wishes. So what I'm going to do is to talk about changes in the landscape of lending that has happened in the aftermath of the Great Recession. Many examples that I'm going to give you are from the US, but the themes apply globally. And what I'm going to argue, a little bit distinct from what we heard today, earlier in the day at least, is that when we think about financial stability, we need to think about shadow banks in a more integrated manner than what we were discussing today. If we don't, I'm going to contend that many of the policies, whether it be micro-pru, macro-pru, if you just look at banks and ignore shadow banks, which include fintechs, you are going to see many puzzling outcomes from policies which otherwise were moderated through the traditional banks. And I'm going to try to make a case about that. What is going to emerge from, hopefully, my trying to convince you is that if we want to do this policy going forward about financial stability, we want to understand the industrial organization of the financial intermediation. And that now includes shadow banks, and ignoring them is not feasible. So with that in mind, let me give you a sense of what is this industrial organization of financial intermediation, how it's changed and why, and then talk about what emerges from this. So let me give you two simple examples. Both come from US, but there are many examples globally that are probably even more remarkable and stark. One is the personal loan market in the US, okay? And if you looked at the market share of shadow banks and fintech lenders, so shadow banks are institutions that don't take deposits and are less heavily regulated. Their market share was roughly 30% in 2007. By the end of 2017, their market share was 50 to 55%. Okay, so that's the dramatic change we are talking about. That's personal loan market. Let me give you another example, the mortgage market. Okay, and here I'm talking about the residential mortgage market. This is not a small market. You might argue that personal loan market, maybe it's not that big. Here we are talking about trillions of dollars. Okay, shadow banks started around 25% in 2007. By the end of 2017, 2018, they had a market share of 60%. Okay, in some segments, the riskier part of the market, they are 90% of the market. Okay? So there is no banks, there is shadow banks. You can't do regulation without thinking of them in a very integrated manner. So these are dramatic changes, okay? And if you think about the residential mortgage market, where I'm going to focus a lot of my discussion on, what is interesting is that in this 60, 70% of market share, if you looked at the top 10 lenders, zoomed in, and asked how many of these top 10 lenders are the lenders of the kind that we were talking about today, well, turns out 6 out of 10 are shadow banks. The largest lender in the US right now is Quicken Loans. And we didn't talk about Quicken Loans today at all, but it needs to. And that's what I'm going to contend. So 6 out of top 10 are shadow banks like Quicken. JP Morgan is there, Wells Fargo is there, Bank of America is there, Citibank is there, but they are no longer the key and the main players, especially if you look at some other segments, some riskier segments in the market. All right, so why has this happened? Okay, so that was something that I and a few of my other colleagues started thinking about quite a while ago. And typically, there are two leading contenders out there for why this may have happened, and we've seen one discussed today, and one is going to be discussed tomorrow. So it's a good thing that I'm giving this speech right now. So regulation or technology. Those are the two leading contenders. On the regulation, people argue that, well, banks face a lot of scrutiny, capital costs, legal costs, and all of that means cost of lending is not competitive, so of course they had to lose out. On the technology front, the idea is that banks may be using technology, but these fintech firms are very nimble, very agile. They are able to originate loans and do other activities like payments at lower costs. They have big data. They are able to use this big data to find the right customers to lend in much better than banks, and they may be providing better services. And there are stories like this, plenty, and not just in the US. So which one is it? And of course, the answer is going to be context dependent, but let me just tell you what we did and what we found in the US. So on the regulation front, we wanted to understand first that there's a lot of discussion, but is there any qualitative evidence that, yes, regulation played a role? And here in the US, just to give you a context, when you talk about regulation after the crisis, immediately people start thinking about Dodd-Frank. They start thinking about Basel III implementation, especially when it comes on the mortgage side. People think about legal lawsuits that happen. People talk about increased scrutiny. And the whole idea then is to see that as these regulatory constraints hit the banks more and more, is it the case that banks retreated from lending? And in fact, did shadow banks then step in and fill the gap? And we sort of found a very strong qualitative evidence for this. What did we do? Well, in US, as you know, there are many regions. And in different regions, there is a different industrial organization of lending. In some sectors, some banks are more dominant than others. And we use that idea to essentially ask that if you looked how banks respond to regulation at the regional level, do you see evidence that banks that are facing a lot of regulatory constraints are going to be retracting from lending, contracting their lending, and shadow banks are jumping in? And we sort of did this. We found that regions where banks are very exposed to regulatory constraints, banks retreated massively. For every dollar that they retreated, about 60 to 70 cents were replaced by shadow banks. Okay? And this was over a period of 10 years after Lehman, essentially. And that has contributed dramatically. What are the kind of regulations we considered? Like I mentioned, we looked at higher capital requirements. We looked at Basel III. We looked at lawsuits. We looked at stricter supervision. And all of these seem to have the similar effect. Regions where banks faced more constraints, they retreated, shadow banks entered. Okay? Now, mind you, this is not just basically that there are some regions which have been uncovered to be really unsafe to lend, and that's why banks are retreating. Everybody should retreat from these areas because, of course, we did a mistake of lending too much. Banks are retreating, shadow banks are entering. So there's something going on here which has some element of regulation to it. Now, one interesting thing that happened is when you looked at, okay, what is their business model really, and I'll come back to this a little bit later as well, is if you looked at what shadow banks versus banks do to the loans, the patterns are pretty dramatic. So traditional banks, as everybody knows, they have the option to hold the loans on the balance sheet or sell the loans, right? So they have balance sheet capacity. The shadow banks, on the other hand, are just pass-through agents. They just sell all their loans to some entities who are willing to buy. In the US, they tend to be federal agencies known as Freddie and Fannie. But essentially, they need someone to buy. Before the financial crisis, it was the private investment banks. Right now, it's the government entity. So shadow banks sell everything. Traditional banks keep about 30% of the loans on the balance sheet and sell the rest. Now, that's going to be important when I talk about policy, which I'll get to soon. What about technology? Qualitatively, okay, regulation matters. What about technology? And recall that when I told you that lending in, for example, the mortgage market by shadow banks went from 20-25% market share to 60-70% market share, that's a huge jump. If you asked how many of these are fintech lenders, because not all shadow banks are really very technologically savvy. Some of them are just doing the plain old banking stuff, but through human touch, through brokers, and so on. But some of them are fintech lenders. So how much of this is by fintech lenders? About a half is by fintech lenders. Okay? Now, what are these fintech lenders doing so that we have a sense of how technology is being used to gain market share? The quintessential example here is Quicken Loans, which I already told you is the largest lender right now by origination in the residential mortgage market. Just to give you a sense, they originate about $20 billion a quarter. Okay, so that's a big amount. So what do they do? Well, they give you a very convenient way of basically applying for a loan. You could do it right now on your phone, essentially. You fill in your name, you fill in where you are from, and so on. A few simple 2-3 questions, and they know pretty much everything about you, which is good or bad. But there's no human touch. There are no documents to upload, and it's very quick. And you basically get to a rate very, very quickly. And like I said, this has helped them leapfrog a lot of the traditional lenders that you would have not imagined a few years ago. If you dig deeper on the technology to understand a bit better what their business model is, and this is going to be all important when I talk about policy, you will see why. Shadow banks are heavily into refinancing of loans. So when you think about loans, you can think about the first-time owners who go out and want to get a loan. There is a credit process and so on. But then once you have a loan, you may want to refinance it depending on the rates and the monetary policy being followed and so on. And here, there's a big difference. Quicken and other fintech lenders refinance almost 30 to 40% more than what traditional banks do. Traditional banks do refinancing too, but these shadow banks are mainly into refinancing. How should we think about it? Well, refinancing means you have already had a mortgage before. Your information is there. I can get that information. I can do it faster than banks, and I will basically dominate, and they have done that. The second margin on which technology plays a big role is, I told you that they sell the loans, right? So they originate the loans and sell. They have perfected that. How do we know? Well, we can look at how much time does it take for banks. Now remember, banks keep some loans on the books and sell the other loans. When they're selling, how much time do they take? They take about roughly 50 to 55 days during the last 10 years on average, if you looked at what's the time period it takes for them to sell the loans. And they are really worried about this time period because this is their risk. This is called warehousing risk. And they've tried to be very efficient, but 50, 55 days is what we are talking about. What about Quicken? Quicken can do it in 30 days. And remember, I'm not talking about the time that they can get the documents and so on. That happens before origination. I'm talking from originations to sale. They can do it in 30 days. Other lenders, traditional lenders, can do it in 55 days. That's a big, dramatic change, and that is where they are sort of able to do things. What other things are they able to do? They are able to use other data. Now, obviously, Quicken and many of these lenders, like we discussed in the last session today, banks and financial institutions like fintech lenders are obviously, want to not share their business model entirely. So they will not tell you what data they exactly use because that's their bread and butter. But as a researcher, you can sort of try to see what is the data that they are probably using. And you can find that there are many different pieces of data which banks do not use, but they are able to use. Now, this is something that you see throughout the world, by the way, where you see unbanked borrowers being given money by fintech lenders. Similarly, in mortgage market, one important variable that lenders pay a lot of attention to is your race. Why? Because regulators pay attention to, are you discriminating on that or not? So if you don't have information on race, they will not, as a traditional bank, not touch you, okay? Just because they don't want to get into legal trouble. What about Quicken? Turns out they lend 40 to 50% more to borrowers who do not disclose their race because they probably know everything about you anyway. So they can do that, and traditional banks can't. If you ask the customer, is it really the case that these entities are offering a different technology, a different convenience? There are a lot of surveys done by firms such as J.D. Power, and fintech firms like Quicken are always rated very highly because they are very fast. They are very responsive to customers, unlike banks who also claim to put customers at the center but are not able to do it as effectively. Okay, so there is a quality dimension to what they do as well. Now, you might ask that, okay, fintech lenders, fine, they're doing a bunch of these things, but what is happening in terms of how much they are charging a borrower? Here is the interesting thing. they actually charge borrowers more, not less. Because one thing that they are very good at is figuring out, are there consumers out there who have a high willingness to pay because their opportunity cost of time is very high. So think about anyone in this room. If Quicken could find you, they would find you. Because you all would not want to deal with paperwork, you would not want to deal with other things that you have to do with traditional banks. Quicken would make it easy for you, and you would pay some premium for that. And Quicken has done that remarkably well, that they have found these borrowers who are willing to pay for convenience and charge them more. Now, the other thing that people talk about with technology is that with this big data, maybe they have better models and you're able to do better things. So clearly, when we go to a segment where there is no banks, you are obviously coming up with a model which banks don't have. And we have enough evidence from China and even in the US that there are these segments of the market where traditional banks were not there, but fintech and shadow banks have gone in, basically because they are able to figure out how to think about your credit history without you really having a credit history. You see that in the mortgage market too, by the way. So how do I know that they are using a model or a big database, something which is different than traditional banks? Turned out, if I look at the default rates of loans that are originated by shadow banks like Quicken and traditional banks, remember they charge more, there are no differences in default rates, okay? Where are the differences? Well, there's a difference in how quickly these borrowers prepay, actually. Prepayment is a big source of revenue for lenders because every time you prepay, you have to, you get a new loan and you have the potential to make fees. So they're able to find people who value time, who are going to prepay, but are not going to default much. And they're doing it right under the nose of the banks and doing it in a very successful manner. So that tells us that qualitatively, technology is important too. So qualitatively, regulation is important, qualitatively, technology is important. How much quantitatively does one versus the other matter? And now, again, this will be context dependent, but to figure this out, you obviously need a model. And with my colleagues, we sort of sat down and figured this out, and we basically thought about the borrower, what do they sort of care about? They care about price and quantity, but they also care about quality. On the lender side, we thought about banks, shadow banks. What is the difference between banks and shadow banks? Well, shadow banks don't have a balance sheet. Banks have a balance sheet. Banks have the ability to sell or to keep the loans on the books. Shadow banks can only sell. And banks have this worry that they face regulatory costs. Now, I heard some discussion earlier in our sessions about, rightly so, that banks complain that they face this regulatory burden, so they are competitively, not able to compete as aggressively with shadow banks, which is true. But they do have the advantage that they have this low source of funding known as deposits, which allows them to have the balance sheet capacity. So many times in the discussion, that is completely forgotten. But when we do policy, that's going to be pretty critical, because if you care about bank stability, what are banks going to be left with is going to be important for us to think about. So we thought about demand side and supply side. And when we sort of did a quantification, here is the key exercise which basically helped us figure this out. When we wanted to understand the scope of regulation, we compared banks with shadow banks as an entity. We did not worry about whether we are fintech or not fintech. And what was the thought experiment? That if everything else the same, which means more specifically interest rates the same, if you find that shadow banks are gaining market share over banks, that tells us something about regulatory costs. What about technology? Let's focus only on shadow banks because they are regulated the same way, and think about fintech versus non-fintech shadow banks. Everything else the same. If you see fintechs gaining market share over non-fintech, that tells you something about technology. When we did this exercise, we found that 60% of what we are seeing in the US is driven by regulation and the remainder by technology. Like I said, this can vary depending on which context you're sort of thinking about, but we sort of think we have some way of thinking about this. Now, there are many other examples where this can work differently. Let me give you another example. There is student loans has become the center of a lot of discussion in the US. And the largest sort of lender there right now, it seems, besides the government, is this lender called SoFi. And what does SoFi do? SoFi came with a very simple product, no big data, nothing like that. When student loans were given in the US, they were given as a pooled contract to students who were low risk or high risk. In other words, we tried to maintain the same loan rate for all students in the US because we didn't want to discriminate. SoFi comes in, they have no problems like that. What do? They just, simple model, which is, which school are you going to? Okay? If you're going to a top 25 school, low rate for you, and that's it. So what did they do? They cream skimmed the entire market. While other institutions and banks do not face the same sort of thinking ability, potentially, or constraints. They face different constraints. So there are many examples, but I think this split of 60-40 is informative, so just in the context of discussions we have been having. So let me talk a bit about where all this fits in with respect to policy. When we think about policy, we are thinking about different policies that we can hit banks with, potentially. And we want to know, essentially, that what type of activities are going to stay with the banks or move to shadow banks. Because clearly, shadow banks can compete with banks. Why? Why does an activity move? And how much? We're interested in all these because if you want to understand policy, you want to have some sense of all these three things. And to do this, you want to sort of understand a bit better the industrial organization of shadow banks and banks. What do I mean by industrial organization? Let me be very specific. What I mean by this is, where are shadow banks active and where are they not active? That tells us something about their business model. Remember, I told you that the business model of shadow banks is selling, so they need someone to buy these loans. Banks, on the other hand, have balance sheet capacity. They sell, but they can also keep a lot on the books. So understanding the business models where shadow banks are active is going to be very important. That's also going to be important to understand the competition, because in markets where shadow banks are active, banks are going to be competing in a different way versus a market where there are no shadow banks. So that's going to feed into the interaction between these two players and ultimately on things that we might want to sort of think about as far as policy is concerned. So the following thought experiment is useful to sort of think about when we think about policy. You can think about the spectrum of lenders out there. On the one extreme are shadow banks, which only originate to sell. Okay? They are pass-through agents. On the other extreme of this spectrum are traditional banks who have a well-capitalized balance sheet. Why? Because they can keep the loans on the books or sell. And any other traditional bank is somewhere in the middle. What do I mean by that? That if you're a traditional bank who doesn't have a well-capitalized balance sheet, well, you can at least be like shadow banks. You can sell. You can originate and sell. But if you're well-capitalized, you'll be on the other extreme, that you can keep the loans on the books too. And with this in mind, you can do some quantitative analysis. And when we are thinking about quantitative analysis, we can think about many different ways in which we want to sort of think about things. But the three that we have thought about are what happens to aggregate lending, depending on different policies. What happens to bank stability? Suppose we only wanted to focus on what remains on bank's balance sheet. What type of risk remains on bank balance sheet? Can we say something about that? And the third thing, which is becoming increasingly important, is the discussion on redistribution. Because depending on where shadow banks and banks are operating and where they're competing, different policies will have different effects on these entities. And then what gets passed through to the economy, which part of the income distribution is going to be affected, is a function of that. Okay, so redistribution is a central part that is going to get affected by this way of sort of thinking. So let me give you an example. Suppose we have these banks and shadow banks competing in the ways that I told you, and we change capital requirements on banks. What would happen? Okay? So quantitatively, when we change the capital requirements relative to, let's say, what the banks were facing in 2015, what you find is initially, banks just basically move from whatever they were doing on their balance sheet to essentially doing what shadow banks are doing, which is selling. What that means is that when you change the capital requirements slightly, by 1%, you don't find a big drop in aggregate lending because banks really substitute just from whatever they were doing on their balance sheet to selling on the books. But as you make it more and more costly for banks to keep the loans on the books, they are obviously going to contract. And they are going to contract quite a bit. Now, what's the problem? Why do we need to think about shadow banks? Well, if we just looked at banks, we would conclude that, well, there's going to be a big dramatic drop in lending. But shadow banks don't rely on this capital requirement. In fact, they can compete even better when banks are weaker. So what you find is that they are able to substitute pretty easily. And for a large range of capital requirements, there is no change in aggregate lending as long as the securitization market remains vibrant. So if you ignored shadow banks, chances are you would conclude that the effects on the bank and the economy will be much larger than they truly are, because shadow banks are really dampening the true effect here. Okay? But this is not that simple, though. Let me give you another example. Suppose we did QE. We did it, so it's easy to sort of suppose. So one thing that QE did is made securitization easier, right? So we made securitization easier, so shadow banks could sort of compete even easily because of QE. Now, if we reversed QE and made it difficult for securitization market to be as vibrant, what would happen to aggregate lending? Well, shadow banks would contract quite a bit because we know they rely fully on selling. Banks, on the other hand, can adjust to this shock. Why? Because they can basically put a lot of the stuff on the books if they need to, and they can compete. They are the only player in town. Shadow banks are feeling weak. They can actually profit quite a bit. So if we focused only on banks in this scenario, we might conclude that, well, this shock is not going to do much to aggregate lending because banks are fine. But if you look at the aggregate picture, shadow banks are going to be affected big time, and the true effect is going to be an amplification of what you really thought. So shadow banks here amplify the shock. So depending on where the shock is, that's my point, that if you understand the industrial organization, you have a better sense of what the true effects of this shock will be to the real economy. And I told you about aggregate lending, but you can immediately see that this will have implications on which part of the income distribution might be affected and what repercussions there might be, what political uproar there might be, and so on. It's always good to be able to predict a few of these things in advance. So let me conclude with a couple of thoughts. So first is more a framework-oriented thought, which is that if we want to do regulation, I think I want to sort of argue that understanding the industrial organization of the intermediation is very important. It's important to understand the business model of shadow banks and traditional banks, not just that they are out there, they are competitors, yes, but there is a lot more going on. And if you understand the business models, then given the distribution of banks and shadow banks in the economy, the policies and what their effects are on aggregate lending, stability, and redistribution becomes much more clearer to see. So I argue that we should sort of think about this. But maybe that's not enough for you, so let me sort of conclude with a more provocative thoughts, which is let's talk about the past and the future, because that's the theme of the FSI conference. So if I look at shadow banks and focus, let's say, on mortgage lending, we know that they are operating at 60, 70% of the market, but in the riskier segments, they are at 90%. We have no oversight on these entities, okay? What could go wrong? Who knows? But maybe, just maybe, they are doing risky lending. We have no way of knowing that. The other thing which is important looking at the future is that a lot of these banks, shadow banks, rely on refinancing. Refinancing requires low rates. As the monetary policy changes, it's going to change how competitive shadow banks can be. When banks are squeezed, when institutions are squeezed, history has told us that they do something which is not necessarily good, because they might go towards more riskier bets. More riskier bets, not regulated, that's something to worry about, I think, per se, even if you didn't think that policy making is where we want to go. There is another reason for you to worry about, which is I didn't talk much about where are these entities getting their funding from. I told you who they sell to, so selling entities are important. Securitization market is important. In US, if you are in US, you are basically bearing the burden because the Freddie and Fannie are financed by taxpayers. So whether you like it or not, you're financing it. But what about Quicken Loans and other entities? Where are they getting their money from? Well, it turns out about 80% of their funding is short-term funding, and it's coming from banks. So whether you like it or not, the risk is also potentially in the banking system still. Where can it matter? Remember the 30, 40 days it takes to sell? That's basically financed by banks. You know, they can put in covenants, they can put in whatever, but that risk is not gone anywhere. And going forward, as traditional banks themselves are getting out-competed on many margins, I think there is a risk that they might also do other risky bets which may sort of come from the left field and might be things that we need to worry about as well. So on that note, I would like to sort of conclude and say thank you for the opportunity.